Let's talk about cap rates, one of the most important and most misunderstood concepts in commercial real estate. If you're new to investing, or even if you've done a few deals, you've probably heard the term cap rate thrown around in conversation. But what exactly is a cap rate? And how should you use it? Let's break it down. Let's start with the cap rate formula. Cap rate stands for capitalization rate, and the formula is simple. It is the net operating income divided by the purchase price. So if a building produces $100,000 in annual net operating income and it sells for $1 million, the cap rate was 10%. If a building with the same $100,000 in annual net operating income sells for $1.25 million, the cap rate was 8%. So a cap rate tells you what an investor is paying for the income that a property produces before factoring in your debt, your interest costs, your capital expenditures, your depreciation, and your federal income taxes. Now let's quickly go back to our example where a building with $100,000 in NOI sold for $1.25 million. You took the $100,000 and you divided it by the $1.25 million sell price, and that equals an 8% cap rate. What if you see a property listed for $2 million at an 8% cap rate? How would you know what the NOI is? Very simple. You take the $2 million asking price and you multiply that $2 million by the 8% cap rate, and you know that the property has $160,000 in net operating income. And so you'll see cap rate in different contexts, and it's a simple algebra equation. Net operating income divided by sales price equals cap rate. And so as long as you have two of those three numbers, you can calculate the missing number, but you have to have two of the three. Now, let's talk about what a cap rate does and does not tell you. Cap rates allow investors to compare deals side by side at scale, based purely on the income the property produces from operation. It ignores the financing of the deal and says, how much am I paying for every dollar of income this property generates? But here's the problem. A cap rate doesn't tell you the full story. It doesn't tell you who the tenant is, doesn't tell you how long the leases are, doesn't tell you if the rent is above market or below market. It doesn't tell you what happens if the tenant leaves. It doesn't tell you how much capital you'll need to put into the building next year, or how much capital you'll need to put into the building if the main tenant were to move out. In other words, cap rate is a headline number, but the real story is found in the details. And here's the key question for investors. Are you more concerned with what your property produces on day one when you buy it, or what your income will be over the next 5 to 10 years during your ownership period? The cap rate tells you where you're starting, but whether a deal is a good investment or not has very little to do with where you start and everything to do with where you end up. Now, let's talk about the cap rate and price relationship. This part's straightforward. The lower the cap rate, the higher the purchase price, and the higher the cap rate, the lower the purchase price. So, why would someone pay a lower or higher cap rate? Well, it all comes down to perceived risk and future performance. Let's walk through an example to explain. Let's take two identical buildings that are 3,000 square feet each. Both are single tenant retail buildings. Both generate $100,000 in annual net operating income. Building A is occupied by Starbucks on a 15-year lease, and Building B is occupied by a local coffee shop with only 2 years left on their lease and shaky financials. The building with Starbucks in it might sell at a 5% cap rate, or for $2 million on that $100,000 in net operating income. But the local coffee shop deal might sell at an 8% cap rate, or only $1.25 million. Same income, very different prices, because one is stable and the other has a lot more risk. Starbucks is a $100 billion company. You know they're gonna pay their rent. But the local coffee shop, they might be 1 or 2 bad months away from having to shut the business down. And when the lease comes up for expiration, the owners might not renew it. They may just decide all the effort that goes into running this coffee shop, it's just not worth it relative to the amount of money we're making. We're gonna shut it down and do something else. And if that coffee shop moves out, you've got vacancy where you're not getting income. To get a tenant in there again, you're gonna have to pay for tenant improvements, you're gonna have to pay for leasing commissions, and it's gonna be a process that you're gonna have to go through. And that increases the risk of the deal. It drives the cap rate higher, which drives the value lower. Now let's look at how cap rates vary based on asset type, even for two properties that are on the same street. Imagine two properties, they're both 90% leased, and they're located next door to each other. One is an industrial park and the other is a multi-tenant office building. Both properties generate $100,000 per year in net operating income. The industrial park might sell at a 6.5% cap rate or $1.538 million. The office building might sell at a 10% cap rate or only $1 million. Same income, same location, $538,000 difference in the value of the properties. So why is the office building worth $538,000 or 35% less than the industrial park that generates the same exact income on the same street located right next door? Well, very simple. Industrial is in favor with investors and office is out of favor with investors. Industrial rents have been rising. Vacancies typically lease very quickly. Build-out costs owners have to provide to attract tenants are pretty minimal. It's seen as a low-friction, low-risk income and a safe, stable investment. Office, totally different story. Vacancies can sit for years. The supply of office space available in the market exceeds demand. This forces landlords to have to provide extensive concession packages to attract tenants. They've got to give a bunch of free rent. They've got to provide a bunch of TI. They have to give all these concessions to accommodate the tenant to the detriment of the landlord to even have a hope of getting their vacancies leased. And so buyers are going to demand a much higher return for office buildings to justify the risk. And that shows up as a higher cap rate for the office building than for the industrial building. Now let's talk about how cap rates relate to interest rates in capital markets. As interest rates fluctuate, cap rates are going to fluctuate as well. From 2020 to 2022, when interest rates were near zero and lenders were eager to lend money to real estate investors, cap rates went down, which caused property values to go up. But from 2022 to today, as we sit in 2025, interest rates have risen, lenders have pulled back, they're not as eager to lend money, and this has caused cap rates to rise and property values to go down. There are fewer buyers, and the borrowing costs for those buyers to get loans are higher. Higher cap rates equals lower values. So when you're looking at a deal, don't just compare the cap rate to other listings. Compare it to where cap rates have been historically for that asset type, for the type of tenants that are in the building, and the market, and the area, and the neighborhood that the building is in. Now here's where investors get into trouble. They treat cap rate like it's the only number that matters. I've seen people buy deals at a 7.5% cap rate thinking they got a great deal. But a year later, the largest tenant moves out, their income goes way down, and in order to replace that income, they have to wait a couple years to find the next large tenant, and they're faced with a massive bill for tenant improvements and commissions. So the cap rate is helpful, but you have to understand the story and the fundamentals behind the deal in order to make good investing decisions. So that's what a cap rate is. It's a tool to evaluate income producing property at a high level, but the cap rate is just the starting point. To make smart real estate investing decisions, you have to understand why the cap rate is what it is, the risks associated with the deal, and the market fundamentals. As we established, two properties with identical income can have drastically different values. Properties that are perceived by investors as stable and predictable tend to have higher values and lower cap rates, while properties full of risk and uncertainty tend to have lower values and higher cap rates. So next time you look at a commercial real estate deal, don't just ask what the cap rate is, seek to understand why the cap rate is priced how it is. And if you're looking at a deal and have questions, please feel free to reach out. We look at these all day, every day, and we would love to help. Follow for more breakdowns in plain English.